Hello, I'm David Cassidy with the midweek summary today, Thursday, the 4th of February. Global equity markets have renewed their upward momentum this week after last week's social media frenzy-induced volatility dissipated and allowed markets to focus again on Joe Biden's fiscal stimulus plans and the global economic recovery. In fact, last week's indiscriminate buying of heavily shorted companies such as GameStop, spurred on by chatroom Wall Street bets on the platform Reddit, while fascinating to watch, at the end of the day appears to us to be nothing more than a modern day pump and dump boiler room style scam. As we said in our last weekly market summary, these companies' share prices have become completely disconnected from their underlying company fundamentals and would not be able to defy gravity for very long. And sure enough, the party quickly fizzled. For example, shares in GameStop, which touched $483 just last Thursday, the 28th of January, have fallen over 80% as it closed last night well below $100. While an old-style boiler room scam, which is illegal, involves unscrupulous people buying shares, then cold calling people with exaggerated claims about the company and then selling their own shares for a big profit, the internet has created chat rooms which allow these exaggerated claims to be made anonymously. Now, unfortunately, this is not illegal, but as many novice retail investors have now discovered, it is financially very painful. The only positive is, given that significant losses most retail investors would have incurred, probably means that these chat rooms will find it very hard to pull off another GameStop-style buying frenzy. Nevertheless, if you were ever tempted by a chat room stock recommendation, please always speak with your advisor first. However, here at My Wealth, we don't believe in speculative trading, nor do we like highly concentrated portfolios, in other words, just a handful of stocks. Instead, we believe that risk management is just as important as investment performance and returns. This means that while we will never shoot the lights out with our investment performance, our portfolios should hopefully allow you to always have a good night's sleep. Economic data so far this week has been consistent with our view that the global economy continues to recover. For example, the US ISM manufacturing reading of 58.7, whilst below last month's reading of 60.5, remains well above 50, which is the line separating expansion and contraction. So the underlying message is clear. The US economy's solid growth is continuing. Additionally, the US ISM employment reading encouragingly rose to 52.6, its best reading in the current coronavirus era, while the ISM services reading improved to 58.7. Now, this all suggests to us that tomorrow, Friday the 5th of February, is non-farm payroll data will show a much better improvement than the 100,000 gain being forecast by major economists. Likewise, the 0.7% contraction in Eurozone's Q4 GDP was much less than the major economists expected, suggesting to us that economies have adapted well to the latest impact from coronavirus lockdowns. Later today, we have the Bank of England's monetary policy meeting concluding. We firmly believe that the next move in UK interest rates will be down, given the weak employment market and recent retail sales data, both of which will get much worse before it gets better. Unfortunately, we aren't expecting the Bank of England to make any changes today due to the bank's wait-and-see mentality, given the recent Brexit trade agreement and the current rapid rollout of the coronavirus vaccines, coupled with the fact that policymakers currently appear to favour increasing quantitative easing, given the pace of the government's issuance, and consequently we will be closely analysing how the 9 policymakers vote.